Welcome to my channel. I'm the covered call guy, and my goal is to create $120,000 per year passive income portfolio using only covered call ETFs. Right now, I yield about $72,000 a year, $6,000 a month, $1,400 a week, and about $200 per day. Legal disclaimer before we start this video: this content is for informational and educational purposes only and is not financial advice, investment advice, or tax advice. I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or completely wrong. Investing and trading involves significant risks, including possible loss of principal. Please always conduct your own due diligence and consult a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random person on YouTube and I could be completely wrong. Now, with that out the way, let's get started on today's video from a request by Emperor Dion X. Now, yes, I've just mentioned cover call ETFs only. However, I've been kind of diverting into closed-end funds. I have not bought any yet, but I am on the fence because some of them are just so great that I can't find a cover call ETF to kind of match it. If nothing comes out within the next year or so to kind of match these closed-end funds where I need some diversification in these sectors or their strategies, then I'm going to go ahead and get some closed-end funds. I would be completely breaking my strategy here. I'm trying not to, but I guess I'm gonna have to change my name to the closed-end and covered call guy. So who knows? Anyways, let's get started. This is my due diligence of Saba Closed-End Funds, the ticker CEFS, right? Thanks to of course I mentioned it, Emperor Dion X left a comment asking for it, and since I've been looking into closed-end fund myself, why not? Like, quick sneak peek. What are we looking at, right? I'm gonna say, all right, guys, listen up. This isn't your average funds of fund. This is an institutional arbitrage vehicle that we can essentially access as retail investors. Launched back in March 2017, CEFS targets one thing: structural inefficiencies. We are talking about exploiting that discount to NAV in the closed-end fund market. Unlike these passive peers like PCEF that just tracks the market, these guys are hunting for uncorrelated alpha using three massive levers: active arbitrage, which just means forcing liquidity events; dynamic hedging, which just means managing duration and beta risk; and discount capture, meaning buying dollars for 85 cents. All right, we got to do a 2025 status health check. The fund is currently capitalizing on a record year of activism. We are seeing a landmark settlement with BlackRock in January 2025 and an aggressive new campaign in the United Kingdom called Mind the Gap. So it's a huge year for them. It seems like they're doing very well lately, especially this year. So, I'll be keeping a close eye on it, and we'll see how it performs within the coming new year. Right, structural mechanics and fees, right? If you guys Google this, yes, I know, I was shocked myself. You see the headline expense ratio and you want to run for the hills. I was like, what the heck? What are you making me do a deep dive on, right? I thought he was crazy. I thought Emperor Dion was crazy for picking this. But stick with me, because understanding this fee is critical to your due diligence. Let's decompose that 4.29% prospective net expense ratio. The management fee, 1.1% goes to Saba. The other expense, 0.83%, interest and custody. And then AFFE, about the 2.36%. This is the tricky part, right? We'll break it down, the tricky part. Structural mechanics and fee. Institutional view on the AFFE, the free fee. What is an AFFE, right? Acquired funds fee inexpensive is just a specific line item in this perspective, mainly for funds of funds or multi-funds manager showing the underlying cost of investment in other funds, which adds to the overall expense ratio and can make it complex and make it look pricier, right? It is not a direct cash cost to you, right? But it does impact you, right? It is not a cash bill that 2.36% AFFE. It is not direct cash fee directed from the ETF's asset by Saba. It is a regulatory calculation of the underlying fund's expense ratio. That's what it is, right? The offset math, because CEFS buy these funds at a discount. For example, if it's a discount of 15%, the fee drag is neutralized. You buy a 2% fee fund at a 50% discount, right? The accreditation covers the 7.5 years of fees. The true cost, what is the actual cost for Saba's active management? It is roughly 1.93%. High for an ETF? Yes, but it mimics the hedge fund's structures. So we always, when it comes to closed-end funds, we do have to make sure we buy the stock at a discount, not at a premium. Right? We have to worry about these things. Portfolio construction, right? You gotta have high conviction, dynamic hedges. Right? This isn't a passive index holding 100 names. Saba runs a concentrated, high conviction book. We are talking about typically 35 to 45 positions. The top 10 holdings represent about 50 to 60% of the net assets, right? As of December 3rd, 2025. Why? Because it has to be an activist. You need weight. You need to push these targets around, right? So the top holdings as of December 3rd, 2025, we have BlackRock ESG Capital, ASA Gold and Precious Metal, BlackRock Science and Tech, Gabe Dividend and Income, Riches Dividend Interest. So these are the top holdings. All right, portfolio construction, high conviction and dynamic hedges, part 2, the hedging part. All right, the hedging overlay. Saba uses derivative to isolate the discount alpha from broader market beta. That just means they don't want your money to die when rates rises. All right, interest rate hedge, short positions in 10-year treasury notes futures, protects the NAV during raising rates environment. And then equity beta hedge, short positions in S&P 500 futures. And of course, is dynamic. The hedge ratio isn't static. Right? So guys, we gotta look at that part. We gotta understand that part. Saba technically adjusts net exposure based on macro views. Right? In 2022, they hedge hard. In bull markets, they might reduce the capture upside. So they're very dynamic, and for a closed-end fund, quite unique. They're the way they operate. So not bad. So far so good. I'm liking what I'm seeing here. All right, activism watch, the alpha engine. That just means Saba earns alpha by hunting for, triggering, and extracting value from activism events in the closed-end fund market. That's all it means. That's what they do, right? The BlackRock settlement in January 2025. This event validated everything, right? They validated what their perspective talked about, and Saba utilized its stake in BlackRock terms trust to force a massive standstill agreement. The outcome: BlackRock agreed to tender offers, right? Biggs, BMEZ, right? Economic value. CEFS realized immediate gains of 15 to 20% on these shares, right? This is an alpha totally unrelated to the market. Activism Watch and Alpha Engine Part 2, right? The UK pivot, late 2025, with US discounts narrowing. Where did Saba go? They moved capital to UK investment trusts, right? So they're going international. Latest action in December 2025, Saba blocked a cozy deal merger between these trusts. They argued it wasn't a liquidity event for shareholders. The demand: Saba is demanding cash exits close to NAV. This is the next frontier, guys. I think they are pivoting away from the US and into international market. They are trying to diversify. This is ultimately a good thing, right? They're trying to protect the shareholders. They're doing what they can to try and compete globally. All right, performance and peer comparison. All right, let's look at the scoreboard. CEFS outperforms by protecting downside with the hedging and forcing upside with the activism. So they are doing both on every end. I am really liking what they do. This was an absolutely good find by Emperor Dion. Uh, so I definitely have this. I'm definitely keeping a close eye on this. All right, so if you see my name, YouTube name get changed to the closed end cover called guy, then you know why. All right, so metric, the strategy, CEFS is active, all right, active and hedge, then versus a passive diversified versus a yield weighted. All right, year to date return, the active CEFS plus 14% versus a passive plus almost 4%. All right, 3-year return just absolutely destroys it, and a 3-year Sharpe ratio just absolutely, completely destroys it all. Rate sensitivity low, right? Because it's completely hedged. I mean, it's doing so well here, right? Institutional takeaway is that CEFS delivered equity-like returns with bond-like volatility. That is amazing. You don't really typically get that a lot. Right, the only thing I can really think of is like maybe JEPB or JEPQ in terms of the cover call ETF counterpart. That 1.1 Sharpe ratio, that highlights the hedging efficiency. So they are doing very, very well. Very, very, on my YouTube channel, barbell like strategy. All right, the long game income and growth. All right, check out this income growth over the life of CEFS inception since 2027 to now. That payout history amplifying some serious increase, right? So from 2017, dollar per share distribution, right? 2017 versus 2024, 2025, and went from $1.34 to $1.88, right? So using an example, the wealth effect on a total return basis, price appreciation plus reinvested dividends. Right, look at what a $10,000 investment at inception looks like today, right? $25,376. That implies a compounded return of 11.3% a year, right? That is power of compounding active alpha, guys. Amazing CEFS. Of course, it would be lower if you were to use the actual distribution to live off of. All right, now I'm saying we are in the accumulation phase. We are all trying to build up. So I'm just going to go ahead and say right now we're not using it all. We're using it to just kind of snowball and compound. All right, is the alpha structural? A key due diligence questions you guys need to ask: was 2025 just a one-off windfall? Because 2025, I mentioned it on all my videos, 2025 was a crazy bull run. Okay, we have to ask that question, right? Just because CEFS was doing amazing in 2025, so was every other stock, ETF, cover call, whatever it was, right? The cynical component non-repeatable. The specific magnitude of the BlackRock settlement gains, which was double digits instant pop, is unlikely to happen every single year. That was harvesting events of multi-year positioning. The structural component that is repeatable though, the CEF, the closed-end fund market is structurally inefficient due to retail dominance. Discount widened due to panic. Saba has a structural edge because passive funds, right, PCEF, cannot participate in tender or vote aggressively. Closed-end funds, the active ones like we are talking about right now, creates its own exit liquidity. My verdict here, the magnitude may normalize, but the outperformance spread is structural. So over the long term, CEF will outperform. That's what they're designed to do. They play both ends of the markets. Right? Key factors to watch out for, right? Like liquidity mismatch, right? ETF is liquid, underlying assets are not. In a flash crash, right? The CEFS NAV would lag trading at a discount. Right, so that's what we have to watch out for. It's not necessarily a red flag. If it trades at a discount, we buy, we load up. Basis risk. If credit spreads blow out, which means junk bond crashes, while Treasury sells off, rates rises like in 2022, hedges might fail to offset losses. Yes, so they might have some buffer here, but it will kind of dislocate valuations. Crowding risk as Saba grows, copycat investors, sidecars, front-end trades, narrowing spreads early and compressing returns just means competitors will start copying everything CFS does with a little sprinkle. Something to look out for. Don't FOMO. Stick with the plan. As you know, there's a lot of high yield ETFs that just boost up the yield because they say a lot of people are getting into cover call ETFs with high yield, right? And it doesn't necessarily work out. Regulatory risk. BlackRock is lobbying SEC to make it harder for activists to accumulate blocks. This could dull Saba's primary weapon. So again, Saba kind of took a couple of the lunch money of BlackRock, and BlackRock is not happy. And BlackRock is one of the biggest, if not the biggest, titan. So we have to watch out for that. All right, valuation and trading guidelines. This is again my guess, my illustration. So take this with a grain of salt. All right, this is just kind of my guess here, my model. All right, so because CEFS is an active ETF holding illiquid assets, you need price discipline. The current status is that you're buying this as of a 1.28% premium. Right, so market price versus NAV plus 2% premium. Action, avoid trim. Right, rationale here is you're overpaying for the asset. 0 to 1.5% premium. Hold, accumulate, normal trading range, and below at 0%, which is a discount. Strong buy. Rare opportunity to buy the double discount, right? My tactical note here is CEFS often dips to a discount during quarterly option expiration weeks. So keep an eye out during those quarterly options expiration weeks. So you can even set a calendar to be like, okay, let's look at this every 3 to 4 months. All right, my verdict here, approved, right? Approved for high income alternative allocations. CEFS is proven to not be a bond substitute. It is an absolute return alternative strategy. By paying that 1.93% effective fee, you gain access to the premier activist desk that forces the big guys to unlock value, right? My final recommendation here is buy for the 8% monthly yield and low correlation to bonds. Monitor the premium discount daily, right? You have to. This that's the only kind of trade-off you have here, is that you kind of have to be an active trader here. Wait for the pullback to the NAV to deploy bulk capital if you're in accumulation phase, and watch the UK Mind the Gap campaign, because success there means the next catalyst for 2026 for this closed-end fund. So I think they're trying to push for international just because of what BlackRock is trying to do to them. So they are really pushing to be ahead of the curve, be ahead of the game. Seems like the management here is really doing a good job, and they're trying to make the shareholders happy. So good work, good job on them. Thanks for watching. Like, comment, subscribe. Don't forget to hit the notification bell. Hope you guys liked it. Hope it was educational, informative. And thank you for leaving a comment for exposing me to more stocks and ETF. Yes, I know it's not a cover call ETF, but in the long run, if it's a good ETF, good stock, I might have to break my own rule and just buy something else that is not a cover call ETF. Because if there's no cover call ETF for it, I guess I'll change my YouTube channel name, right? But as of right now, I am still the cover call guy, and thanks for watching. Appreciate it. Catch you guys on the next. Stay tuned.